I'm really excited to be here, and this is the first time that I have been to this campus. And one of the things that I would say to you is that I do a lot of mentoring of university and postgraduate students. And so some of the things that I'm going to talk about today is really where is the market going and how do you fit into all of that. And I think from my point of view, the one thing that when people say the future of finance, we could be just talking about tomorrow. Tomorrow is the future. So I always think it's kind of important to talk to people about what time horizon. So often the people kind of say, oh, well, that could happen in, I don't know when. Today's conversation is actually going to be talking about the future of finance 3 to 5 years from now. So not that far, but for all of you, the time that really matters. And so when I talk about all of this, really at the end of the day, what's most important for all of you is to take away one or two things out of this conversation and say, okay, what would I do differently? So when I position my company, but also my mentees, one of the things that I always say to them is there's four things that are going to intersect in the capital markets: people, processes, technology, and the market itself. And so the first thing that I would say is, well, why? And what I would say is each parts of those are always evolving and they're always impacting each other. So technology can't work without people. People can't work without technology. We all need processes for, whether it's data, whether it's modeling, and we'll talk about some of those items. But at the end of the day, the key thing for all of you in this room is to realize that you're going to be the next passengers in the financial markets. And you can be an active passenger, or you can actually just be the driver. And so really part of the things that we're going to talk about is how do we position ourselves as drivers in a market that's going to look different in 3 years or 5 years time than it does today. So I think when I think about people are the ones who get to decide which models, which data do we use, which technology. The one thing that all of you are naturally trained in is a very strict quantitative way that you think about attacking problems. And what you're going to encounter is in the workforce, not everyone's going to think the same way because they haven't been trained the same way. There is something about going to an elite university that your thinking style is going to be different than others. And what I always say to, particularly my doctoral and postdoctoral candidates is often you have to be able to just explain how you're thinking about this problem. So you may come from a different training. So I came from a math type background. I just think about problems very different. And I had roommates in college that were all engineers, and they thought about problems differently than I did. And so ultimately, at the end of the day, what I find myself, and I'm going to talk about this both as a thinking style and a communications, is how would you explain it to your mother? And I'm going to start. My mother's very smart. My mother was a college professor, but my mom was a college professor in nursing. So she knows nothing about the financial markets. And so what I found myself is my hardest customer was to explain what I did for my mother. And if you can actually think about that, like how can I, and again, it's not, and I want to be very clear, I am not dumbing it down for my mom. But I have to be able to explain it in a way that she's going to understand. And the way that you show that you master a concept is to be able to break it down into small blocks and explain that to people. So as you're learning some of the most complex things in the financial industry, think about how you would explain that to your mother. And it's a really hard challenge, and it took me years to be able to explain it to my mother. Um, but but I found that that was a good way for me to take the way that I was thinking about it and translate it with other people who were, potentially, thinking. The other thing that I would implore you is not to think that this is the last time you're going to learn something. So you don't come to school and you don't learn everything in school. And I always say from a perspective of what do we need in the future in this industry is people who are committed to continuous learning, that they're naturally curious, that they're going to take potentially a very complex problem and break it down into very simple, concepts. And I think from a point of view, natural curiosity means that you're looking at data that maybe other people aren't looking at, and you're trying to solve problems that others haven't been able to solve. And that comes from a kind of a mindset of continuous learning. And I'll talk about myself. I spend at least a half day every week on research. And that doesn't happen on Monday through Friday. And so I make a commitment to myself that as a continuous learner, I need to study the markets. I need to learn from other people who know different parts of the market differently than I do. And for me, that's about, it's about 3 to 4 hours every weekend reading, probably somewhere in the neighborhood of anywhere between 700 and 1,000 pages of research every week. But that enables me to interact with my counterparts at some of the largest banks in the world because I understand some of the problems that they're dealing with, and allows me to, inform how we need to manage risk in our organization. So that's the people block. The next block is process, and I'm going to spend probably a little less time here, but process is probably the most exciting area that is going to grow out of this data-intensive world that we live. And I'm very bullish on RPA, so robotic process automation. And I think that this is an area in 3 to 5 years that is going to take jobs away. Let me be clear. Technology will take jobs away. Those are not the jobs that anyone in this room really wants. So it's okay. Let technology take the jobs we don't want. And I think things like digital assistants and other automation tools and business intelligence tools that mine data and parse data are going to become very valuable in the next, really, this is on the short end of the 3 to 5 years. This is really in the next, three years. On the tech side, what I'm going to start right with quantum. I spent some time today in the quantum key lab here, and so I'm going to start with, quantum is going to be a game changer, probably closer to the 5-year mark than the 3-year mark. I think encryption. Anyone who's very interested in encryption and data, that's going to be a very growing field over the next 3 years. So I certainly encourage people, if you like cryptology, you like puzzles, cryptology and quantum is the space. I'm probably a little less bullish on quantum for algos, and that was kind of confirmed by some of the discussions that we had today. So I do think that there may be some developments, but I don't know that they're going to be of the same caliber as what's going to happen in the encryption. The other thing that I will warn you on technology is technology will always let you down. And so you cannot be 100% reliant on technology. The concept of that your phone is going to give you all the answers, that ChatGPT or Perplexity or any of these other tools are going to give you the answers. They'll give you some answers, but the reason why you're in school is to challenge the answers and think beyond how the computer is thinking. And at the end of the day, I think from a point of view, when I was growing up, one of my neighbors was a test pilot for one of the airline manufacturers, or not airline, actually military aircraft, and he flew every other aircraft that came off the assembly line, and his job was to take those planes and exceed the specifications that were required, whether it was the Army, the Air Force, the Navy, or the Marines, and deliver them. And at the end of the day, whether that was 110% of the specifications or 140% of the specifications, you're going to have to take risks. And at the end of the day, the value in taking those risks is have them be very calculated. Consider like practice rounds. My mom was always a practice round. But at the end of the day, find safe places where you can take risks. Practice things with your fellow students. I take the opportunity while you're here to leverage this network that you have, because you won't have this exact same network ever again in your life. And this is a chance for you to take some risks when it won't cost you very much. And so I certainly encourage you to take some risks with technology, take some classes that you might not have taken. This is a safe space to take risks, and you're doing it with people that are here ultimately to support you. And we're going to probably talk a little bit about like the growth of digital. And that can be everything from crypto assets to stable coins to kind of, a very emerging area, in finance today, where the technology is very much driving the solutions, and eventually the solutions will drive the technology. And so, I think we've got it backwards right now, and in the next 2 to 3 years, we're going to see solutions where then the technology has to adapt rather than the other way around. So where this really gets interesting is ultimately, how does this impact the structure of the capital markets? And what I would say to you is every 10 years, we are expecting, it doesn't mean it will happen exactly every 10 years, but I'll kind of go through some near examples. There is a major shift in the financial industry. And the reason why I say this is very, very important is that what you're going to hear from me is that probably we are now 5 years into this cycle. And so ultimately COVID was probably the last major shift, not necessarily in a good way. And I'm going to kind of explain some of the things that I've seen that have come out of that period. But rewinding backwards, the great financial crisis that came out of 2008, which in the US is typically called a subprime crisis. There's the dot-com bubble of the 2000s. There's 1987. There's the oil crisis of the mid 70s. These generally come in cycles of 10 years. And we can always argue there's tariffs going on, there's other things that are going on that are going to majorly shift the market. And that may be true, but I'm going to explain to you why I think it won't necessarily be true, less about tariffs and some of the political challenges. But a lot of the things that you're seeing that are happening in the market today trace all of their roots back to the COVID period. And so we'll spend a little bit of time, kind of talking out that. But I think one of the things that, the crises may not wait, but they are very exciting opportunities. So if you think about the timing of when you're done with your studies, not to scare you, but you should anticipate a crisis pretty quickly after you graduate. And so, I think from a point of view, the industry seems to make similar mistakes, kind of what I call over and over, but they generally come in this, 8 to 12 year cycle. And so, I think, from a point of view, I'm going to talk a little bit about like what is going on. Like, so we're getting a little bit more insular in our thinking. It's often called populism. and it's happening here in India. It's happening in the United States. And what I would say is that is largely growing out of the scare that we had in COVID. And I'll probably in a couple more minutes explain why I think that's really, really important. And so at the end of the day, because these crises are happening at this kind of frequency, what we see is that the role of the central banks, kind of on a global basis, are taking a much more active role. Typically, central banks are responsible for two things. They're responsible for keeping inflation at a target level. So it's different in India than it is in the US. So, there's much more inflation here than there is in the US. But we are struggling probably more with inflation in the United States today than we were 5 years ago. And the other thing is to maintain a steady growth of jobs. It's not to support the economy. It's not to bail out the largest banks when they have a challenge. But what we have seen since the great financial crisis is that central banks are taking a much more active role. They're stepping in at the smaller signs of crises. They're trying to support the market in different ways. But if we're moving towards populism, that will probably change, and it'll probably change in a way where I'll pick on the European Central Bank. They're going to support European institutions, even if that's at the expense of U.S. institutions. And so we just need to prepare that some of the safety net that we've seen and that you've studied over the last couple of years is actually changing. And I think from a point of view, this is where digital now comes back into the picture. Digital is a new paradigm, and it allows assets and potentially money to be exchanged 24 hours a day. And again, whether it's an algorithmic coin or it's a stable coin or it's potentially just a real money asset that is in digital form. I'll start with real money assets in digital form. We've been doing this for years. This is not new. There's a central securities depository here in India. They've been doing it for years. My company's been doing this for years. We've been taking things and putting them in digital form. Can you tokenize them and put them on blockchain? The answer to that is yes. But that technology is just being layered on top. This is where the technology is driving the solution rather than us as a market participant saying, what technology do we need to support it? I think from a point of view, the other thing that digital allows us, potentially to do is largely around, our clients being able to move things across borders. And again, the central banks may have a long-term view on this. They may think that that's not necessarily a good idea in the new world order that is kind of emerging right now. And so how would the central bank potentially solve that? Well, what stops the central bank from issuing a central bank digital currency? And they can, and they probably will. Will they do it in 5 years? Truthfully, certainly in the US markets, I think the answer is no. I can tell you that the central bank has other priorities. But what I would really say is that what is still challenging in the digital space is that it still relies a lot on intermediation. It means somebody has to step in and offer that solution, but it doesn't mean that the original counterparties aren't party to that transaction. And so what you've kind of introduced is a layer of technology and intermediation that may, from an app perspective, look invisible to you, but behind the scenes, all the traditional bank relationships and all the intermediaries that are in that value chain are still staying there. And that probably will change. Again, I think that's longer than 5 years, But certainly we're going to see some very interesting things happen in the digital space. And I think anyone who is, interested, again, let's leave away what the value of Bitcoin is, because I don't know what it is. I can just tell you it's not 90,000 a Bitcoin. Um, I have a view, probably a lot lower than most of the people in this room, but you're the ones who are trading that currency, not necessarily myself. The other thing that's going to evolve in the next 3 to 5 years is data. And so anyone who is studying data science, those jobs are going to be in tremendous demand. But what we're going to see in this new world order that we're kind of evolving towards, which all could change with changes in political leaders. So I don't want to say that this is a crystal ball or anything like that. But at the end of the day, the data is going to become much more regional. But there's things that I can learn from data that you see in India that could potentially inform how markets could be operating in the US and vice versa. And so there's lots of things going on in China today that, if we could extract out all the data, we might have better analytics. But there's always challenges with data. And, many people have heard the quote, when a butterfly flaps its wings, a typhoon shows up. So the butterfly's in Brazil and the typhoon is in the, South Pacific. Well, you know what? It could just be a butterfly flapping its wings. So sometimes data doesn't necessarily lead to direct causes and effects. There are things that may be correlated, they may not be. And so being able to basically dissect data is going to be a growing need for everyone. So I always encourage people, spend time with programming, because you cannot do data management without being I'll call it a decent programmer. I don't think you have to be a good programmer to work with data. The other things that I do see, kind of growing in the future of the market is there is a growth of what is called non-bank financial institutions. This is often called hedge funds. And they're taking on capital raising, they're taking on credit transfer, things today that weren't happening, 2 or 3 years ago. And they're becoming much more active participants. And fundamentally, you probably have to ask yourself, why would a bank sell its loan portfolio to a hedge fund? Doesn't seem to make a lot of sense. But often the banks are capital constrained, and this is a way for them to not only move risk, but more importantly, move capital. And capital becomes important, but probably not as important as funding, or what the market typically calls liquidity. Liquidity is less fungible than capital. It's much harder to move liquidity across borders. So the idea that things in the digital space could help with funding markets is probably where some of the bigger growth is going to be, while things like capital raising get easier with things like digital assets. And so, I think, at the end of the day, it's about seeing these signals and all these various signals, and how do you make actionable kind of intelligence from all of this. So let's tie it all together, and then I'll kind of open it up for questions. Has anyone in this room heard the term PDOOM? We got one. All right. So let me talk about what PDOOM is. So PDOOM is a term that I call it my kids talk about. So for example, there's a lot of terminology that my kids use now. It's not slang, it's not memes, it's just, things like, instead of saying I'm going to make a reservation for dinner, they refer to it as the app. I'll make a resi. So if you've ever heard this, this term, so saying resi, I'll make a reservation for a lunch or a dinner. Mom and Dad, I'll make a resi. Okay, all right, you're cooler than I am, so I get that. What my kids have been talking about for the last 2 years is PDOOM. They are not morbid people, but the concept of PDOM is often attributed to artificial intelligence. And we haven't spent that much time on artificial intelligence, but what PDOM is what is the probability of a catastrophic outcome? And it can be as morbid as the impact to the human race. It often in artificial intelligence terms is kind of the Terminator or Skynet analogy that the robots are going to come and take over society and ruin it as it's done. But what I would say to you, and this is why where we stand today is very tied to the COVID period, is that post-COVID, the thought of extreme events is not as extreme anymore. People are thinking about this not all the time. We don't wake up and, this is really bad. But at the end of the day, the most important thing about PDOM is that people are putting higher probabilities on very extreme events today, kind of post the pandemic, because they have witnessed something that has happened once in 100 years. And so there's a cycle, and the cycle could kind of come faster. So I'm not going to say like the next pandemic is only 100 years away. But at the end of the day, the reason why people are focused on extreme finance is that people saw things like the impact of social distancing. They saw supply chain change problems. And so what you see is that there were knock-on impacts of a catastrophic event that are still occurring today. And when my family asked me how long did I think COVID was going to last, I said, well, the medical studies say 5 years, and that wasn't very popular 5 years ago. Today, it's like, oh, well, that actually makes it probably did take that long to kind of work itself out, but we're still feeling the impact. So inflation is higher today. The government across the world dumped tons of money into vaccine research and other stimulus packages that are still having residual impacts today. And so that people ultimately are thinking about this and what does this mean for kind of the future of finance. At the end of the day, the market is more focused on kind of these extreme events than they were, 5 years ago. And I think from a perspective, what's happening now is that people are being asked to make faster decisions with less information. And so, ultimately, what does that mean for all of us? Where the opportunities are in finance, believe it or not, are going to be in process. And even though I didn't talk about that much, at the end of the day, there's two things that are going to happen with processes. Artificial intelligence, machine learning, RPA, those are going to change all those processes and help kind of quantify and bring actionable data to the tips of all of us when we're doing our analysis. But the folks who are ultimately going to be successful are those who are able to take those processes, and when data is coming at you fast and furious, how do you simplify it and make it actionable? And so that tying this all back to how do you explain something to your mother? At the end of the day, the people who are going to be valuable in the financial industry aren't going to be the smartest quants. What they're going to be is the people who can take those very difficult, complex situations and simplify them, because most of the people that you're going to be interacting with didn't have the same education that you had. They don't have the same thinking style that you have. And so, I think from a perspective, the value that you can have isn't to think, okay, all the technology, I'm going to wait for the new technology to emerge and wait for all the processes to change. You have to kind of look at all of those pieces and figure out how you break it down in a way that can actually make them more simple, because the world as we know it is getting more complicated, it's becoming more correlated, and those extreme events are top of mind for most market participants. So although no one, in the marketplace walks around and says, "Oh, I'm thinking about PDOOM," what I would tell you is their actions suggest otherwise. The reason why there's things like tariffs and other things going on is to, protect supply chains. Why are we still protecting supply chains in a global economy? Many of these things are at odds because people are still thinking about the fact that something that happened once every 100 years could happen again tomorrow. And so that idea of extreme outcomes, again, we can all argue whether the probability has really changed or not. I could make some arguments either way. But what I would say is that people's inherent bias are implying higher probability to extreme events today than they were 6 years ago. And because of that, that's going to influence how the markets continue to evolve. So although it is a very dismal thought, the concept of thinking about the fact that extreme events are things that are driving investment decisions are going to drive the future of the financial markets. So I just wanted to leave you with a couple of thoughts there, and certainly happy to kind of open it up and take questions.
So right now, in the domain of artificial intelligence and data science, we see that we have plenty of data right now. And like right now, if you see those big corporations like any other financial corporation, they have access to that plenty of data. But majority of the data, like if you see, is not fit for making right decisions. You see a lot of junk in that data. So how do you rely in the finance sector on, like, how do you incorporate your decisions, including like by dividing like which data is fit for making decisions and which is not?
Yeah, I think this is something our organization, is honestly struggling with, and we spend a lot of money cleaning our data. We have what I call a very robust process around data, but there's always going to be data anomalies because at some point somehow that data was captured, and it could be a human error, it could be a technological glitch, and things like that. So the area that I'm most encouraged about in the data science area is actually the folks who do sorting. And they're working on algorithms to better sort the data and spot those anomalies. And there's two things you can always do with anomalies. You can ignore them. You can set parameters that are dynamic to weed out what you believe to be anomalous data. But when markets are changing, and this is where we have some challenges, when you start to see extreme events, and again, I'm not trying to tie everything back to extreme events, those parameters that you set were wrong. And how quickly can you adapt that? The machines are not fast enough yet to understand signals from markets. And there's times that, particularly in the US, we saw a big shift in what interest rates were, and that drive very different decisions by our clients, and it led to a lot of false positive data that looked anomalous. And so there's always kind of changes. It's easy when the markets are what I call stable. It's harder when they're different. But the people who figure out how to sort this in the future, that's where probably the value is, because I need clean data sets probably more than I need financial modeling.
So you talked about extreme events. So my question is from both people and process perspective. How do you personally think about tail risks, and what kind of processes you have to in your firm to hedge those kind of tail risks?
Yeah, so let me start with, we actually have a group of people in my organization that are actually called the Extreme Risk Group. So again, it probably sounds like I really think about the destruction of the earth all the time, but unfortunately, the things, and again, if you look at it like, just looking at weather patterns, right? There's more extreme weather patterns and things like that. So We actually have a group that spends time about that, and then trying to understand not necessarily how you hedge the risk, but how you could potentially put some controls to mitigate those risks. So extreme risks are very difficult to hedge. They're actually the hardest. But it also means there may be other tools that you could do to spot extreme, I'll call it behavior, before it actually happens. And so there are kind of a series of what I call extreme events that we're constantly tracking. Some of them are based on historical events that have already happened. So COVID would be, kind of an extreme event. But there are other things like the rise of quantum computing and things like that that haven't happened quite yet, that we need to kind of understand how they could impact the market. So certainly from our point of view, we actually just have to have a team that looks at this and kind of keeps an inventory and basically kind of sorts them as a little bit to likelihood. So, the likelihood that Modi wins the election, right? Well, that's a high probability, that was a high probability event. It wasn't a guarantee, but it was a high probability event. Well, we're not going to track that as much as we're potentially going to track something that is a little bit more extreme and has a higher likelihood of happening. So we try to track these based on likelihood of occurrence and severity, and whether there's things that we can do to mitigate some of that risk.
So you were talking, like you were saying that markets have become very paranoid since COVID regarding errors. But like if you hedge funds or people like Taleb, they would say it's good to be paranoid, isn't it?
Yes, they would definitely say that, and they're looking for those. If there's somebody who's looking to profit from that extreme risk mentality, both the likelihood it could happen and then potentially the other side that it doesn't happen, it's probably going to be hedge funds.
So in the sequence of catastrophic events, there are always indicators which will tell you beforehand that there is something coming right ahead.
Mm-hmm.
According to you, what indicators you potentially look for in your career or in the future?
I think a lot of it is actually based on the markets that we participate in, and so for me, one of the things that I look at is leverage. So how does leverage build up in the market? So there's many trades that you cannot make much money doing it if you invest 1 rupee against that. But what if you only had to invest 1 rupee, but you borrowed 20? Well, you can potentially get 20 times the return. You can also lose 20 times as much. And so what we see in the market and is ultimately there's always a little bit of a buildup of leverage, and you have to know where to spot it. And this is what I call a data problem, because at the end of the day, the data for some of these sectors, particularly the non-bank financials, which the hedge funds are part of, are not the most transparent with their data. And so a lot of the data, they're still required by the regulators to file things, but they're allowed to do it several months later than this, and they only have to disclose certain types of information. And so the challenge for us is, how do we get that information a little bit more real time? And so we've been trying to build data sets in the United States, both by the government as well as the financial sector, to be able to kind of track how much leverage is potentially building up in the market. And like right now, what I would tell you is, as the market has kind of sold off, we're seeing actually a kind of what I'll call a good trend. Leverage is actually going down, and those positions are moving to more traditional places, but again, this market's only down, on a relative basis, nothing what it was during COVID. And what we saw during COVID is many of the big leverage positions lost tons of money. And so it can be challenging, But then there's things like GameStop that come along, right? And all of a sudden it's the other side of the COVID trade. I'm going to bet on some extreme event the other way. And many people made lots of money off their GameStop holdings.
Yeah, right now with the tariffs war coming and with the Trump administration, we see that the press release him not clapping about the recession. We see Nasdaq shedding about $5 trillion in just a week. So, how do you approach these kind of overnight events from a risk management perspective? How do finance firms approach these kind of events, especially with today's current volatile geopolitical and political environments?
Yeah, I mean, I'll start with it. Often gives me a headache, and so, what I, again, there's a lot of economic theory among tariffs that we can certainly kind of talk about, but what I don't quite understand is that, if you're going to have a tariff policy, why would you do this in 1 month increments? Or why would you do it in weekly or potentially hourly increments? Like I do kind of struggle. And so from my perspective, as a market participant and one who follows economic trends, these tend not to be based on rational choices. And so when things aren't based on rational choices, they typically have very unintended consequences for the market. And I would just say a 10% reduction in, kind of the US capital markets over the last 4 weeks is actually a pretty rational response to what's going on. But if this continues, we should expect that the market will take a more irrational response, and we could see pretty significant drops in equity volume or value, and not just for the Nvidias of the world and the tech sector, but more broadly, which ultimately will have impact on the growth of the economy. Right now, the economy, on a worldwide basis, not just a U.S., is still strong, but I don't think it can weather a tariff war, and so the question is, does it slow, gradually, or does it really come to a screeching halt? We're starting to see data signs in the U.S. that suggest that it is not necessarily recessionary, but it is going from what I would call above trend growth to significantly below trend growth. So something in the 1 and 1.5% range for the U.S. is suboptimal. Anything above 2% in the U.S. is above what I would call kind of most economic theories in terms of targets. And so we're going from, right now we're at 225. If we drop to 1.5% in the first quarter, that could be really scary. And those are numbers that we're potentially looking at. All right.
Thank you so much, Tim. And it's absolutely, thank you so much for visiting IIT Madras campus and sharing your rich experience and very valuable insights about the global markets and the risk aspects and all of that with our student community. I think it was a wonderful discussion, and we would also like to put on record our sincere gratitude to the DTCC team, Chandra, and all of you. Thank you so much, and look forward to nurturing this relationship further. Look forward to seeing more of you in the campus in the months to come.
I'd be happy to do it. So thank you. Thank you very much. Perfect. Thank you. Of course.